I'd make one journal entry. I'm just going to show you this. I would make one journal entry, and what I would do is essentially work with the fair value. And I would make one entry. Most books make two entries. The one entry I would make, I'll put this on the side, I would debit the cash account for the amount I receive. That would be for 185, 363. I would debit the loss for 1,000, right? That's all I really need is 1,000 more loss. I mean, you could do it this way if you want, and then I would debit the allowance account of 3486, and I would credit the investment. 189,849. Yeah, okay. All right, so that's what I would do. Because it avoids the adjustment. Most textbooks want you to use this adjustment. I would rather avoid the adjustment and just take the net loss off, considering the basis of the asset at fair value. And in that way, now I get rid of the allowance account, I get rid of the investment account. So you debit cash for 185,363, you debit the loss for 1,000, you debit the valuation allowance, get rid of it, and then credit the investment account. And now you had a prior loss of 3486 plus the loss on sale. Now, the problem with this approach, I'm going to tell you how, you know what, I mean, people will argue theoretically, I guess, I don't know, they may have some time on their hands, but this technically is not the loss on the sale, right? I mean, so it's a misclassification. That's why they prefer, most textbook authors prefer that you debit the loss for 4486, it's consistent. Which way is more confusing? Have two different ways to calculate a loss, one for available for sale, one for trading, or calculate the loss the same way and then make the adjustment a little different. I mean, it's up to you. Okay. Regardless of how you do it, the total loss that could hit income against the income statement on a trading security has to be 4486. I don't care which way you get it, but you can do it either way. And the net result is on the bottom of, this now is showing up on the wrong page, but on the very bottom of page 9, notice what happens. I mean, you get the same loss, but it's a matter of, if you look at the table up on top, it's a matter of the timing. And you notice that in 2014, the loss for the trading portfolio is 1,000. So if you look at the timing, the only difference is timing. Cash flows don't change, nothing changes. Cash flows do not change. So that in 2012, trading takes a gain of 33.75, no effect on available for sale. In 2013, there was a loss on the trading portfolio of 68.61, no effect on the available for sale. And then finally in 2014, they catch up. The loss for available for sale is 4486, but the net loss that you see flowing through is 1,000 for the trading. Yep. Classification-wise, yeah, it depends. You're right, absolutely. If this is a financial institution, you're absolutely correct. The cash flows on a trading portfolio would be operating, and for an available for sale would be in investing. Classification would vary, but the totals would be the same. Yeah. OCI. No, I don't know if it doesn't have the difference because we clear it out. We clear it out over here. So on the OCI, We basically don't affect income here. We just make the adjustments to the accounts as needed. So, say you could have made the sale entry the same way, I guess, but you don't always remove the allowance account. That's the thing for an OCI investment, because you may need that allowance if the other securities you're holding in the portfolio actually decline in value. So this is kind of unique to the trading. The situation is unique for the trading. So the other comprehensive income is pretty straightforward. There's no real need to make the adjustment here. The only reason why you're making this adjustment right here is because the securities it's a one portfolio security. This entry right here would be the other alternative. Yep. Well, that loss is realized. So you're not trying to avoid it. I'm sorry?
Sorry, that's the FS. And in trading, we're removing that loss.
Because it was already recognized. Right. Yeah, but in this case, if you go back here, and I want to make sure I understand the question. In trading, you never recognize any gains and losses until it's actually realized on the sale. Here, you've already recognized, gains and losses, so you have to be sure you don't double count them. So trading is different because trading has already been recognizing gains and losses. So OCI doesn't have the need to adjust. What's that? Well, no, but you're not unwinding prior income. You're recognizing the income all at once. Here, you have to unwind some of the prior income. You have to get rid of, for example, you've got to add back 3486 of earnings. So yeah, it's going to be the same. You're not going to get any different result. It's a matter of timing and the way it's got to be done. With trading is that you just can't go ahead and add another loss to an existing loss that was already recognized. And that's the difference. It's just a matter of timing, and the approach that was used in the textbooks is the one I'm showing you, but that would probably be your, I'm sorry, what? That would probably be the most common approach. Well, obviously, that means it's time for a break. All right, so we'll stop here. We'll come back 15 minutes. We have, according to my calculations, it's, 15 minutes, and we'll be back. Because I just said it's a break for someone to snap it. Okay. It's probably easier if you want to read it.
I should be fine with those reports that I'm taking now,
Yeah.
correct? Okay.
Yeah, it's just that 36 business credit thing we have to work out with some people.
Thank you.
I'm dying. You expect anything else?
I'm sore too. That point, not to play there. I've worked in all year.
I'm tired. Oh, yeah.
All right.
Yeah, come on. You want to today? Tonight's the night to quit.
The other coach who we work with,
Give me
Rachel
that small
Mitch,
set.
said that she's not coming to work today.
That doesn't work.
The other coach she hated. She said she's not coming to work, she just didn't tell me. She said, I was walking into my car on Monday night. She's like, I'm not coming. They literally had no, she was going.
Oh, you found your bag after tell them to come up to the city.
You know what I'm considering?
Here's the flag.
This is well, I'm trying to do it.
I know, yeah, sure. Yeah, don't. Lecturing the captures, screen my voice. Yeah. Okay, now I see whole separate sections, so anyone who's out for holidays, I'll see what we want to eat, we'll go over the lecture again.
Good job, good job. We were just saying. No, I didn't hear you. No, it's funny. I knew how to talk about it. I knew. It's funny because we were just saying that we said we'll get everything coming up. I know, right? Oh, yeah, really easy. They're productive. Yeah, I know that. This should probably be easiest material for the
You know what it is? They have to wait until the other guys come out. Because they think that you as a professor are going to say, all right. All right, I'm going to try to get back. Hello? All right, we're going to try to start up again. If you go to page 13, I'm just going to talk a little bit about the disclosures. In between where we stopped in page 13 is this multi-portfolio illustration that you should look at. But I just want to go through some of the disclosures with you, and then we're going to move on to the second module, which is pretty theoretical. It deals with the disclosures that I think a lot of you have seen. I think it's important. So pretty much we're going to be looking at disclosures. What I've done for you here on page 13, this is a research company. This is a national company. I changed the name and the dates and some of the numbers. And one of the things you can notice on their income statement, this is a research and development company. And you notice that a lot of their income is going to be interest income, because if you look at the highlight where it says interest and other income, they have a significant amount of interest income, because what happens in a research company like this is they will get either donations or you'll get companies to give them money up front to do research. The money's going to be sitting there and they invest it and they keep the obviously the interest. So you can see that the interest income is rather significant. Also below this, there is a two-statement approach. This is a separate statement of comprehensive income, and you notice it starts, there was a net loss, and then of course they have their comprehensive income items. Now, on the balance sheet, notice they have investments in a couple of places. They have short-term investments. Now let me just put the numbers up here for you. They have short-term investments. I don't know, if you can't see this, if you can move over, because this is about as good as I can do with the board. Short-term investments. Now they have investments which are, these are basically long-term, $73,416,252. And then in other assets, that's highlighted in green. In the footnote, they tell you that in other assets they have, and these are equity securities. They have equity securities of $3,574,000. I'm going to show you where this is in just a second. All right, so let's get out of the way. So the total value, the total balance sheet value of the securities that they're holding, are 325,995,102. If you compare that to the total assets they have, and I'll highlight that in a second, if you compare it to the total assets, let's say in 2013, it is, sorry, just move that, 391,297,215. So their investments are about 83% of their total assets. I mean, they're carrying 325, and if the total assets of the company are 391, 297, 215, that is about 83% of total assets. So for this company, the disclosures are critical. I mean, this is a huge part of their total asset base. And in fact, this is why, if I just go up again to comprehensive income, the unrealized gains and losses on these securities are very important. You know, obviously now, these unrealized gains and losses, if this is an available for sale portfolio, if they do sell these assets, it's going to be a critical part of their gain and loss or income. So again, on their balance sheet, short-term investments, long-term investments, and in other assets, in a footnote, which I'll show you in just a moment, they are carrying equity securities valued at $3,574,000. Okay. And the other, which are probably debt securities, which we'll see, are 322. So these are debt securities. $322, $421, $102. Now, when you go into the footnotes on the next page, the footnote talks about their debt securities, and it tells you that debt securities that the company has a positive intent and ability to hold to maturity, which comes right out of the textbook, are classified as held to maturity. All of the debt securities are classified as available for sale. Fair value is determined on quoted market price. In just a minute, we'll go through the fair value model and show you how and why this is done. And then, of course, they treat a part of their short-term investments, 119.4, as available for sale. And short-term investments consist of U.S. Treasury and other government securities, commercial paper, and notes. Short-term investments classified as held to maturity. That means that they have available for sale as short-term, held to maturity as short-term. It means that you have to prove to the auditors that these are being held as working capital. And of course, classified as long-term would be typically the classification for held to maturity and available for sale. Now, when you take a look at the footnotes, they give you, and this is what you'll normally see, you'll see investments carried at cost and carried at fair value. Now, for the held to maturity, let me highlight that for you, the held to maturity and available for sale. And these are debt securities. These are the debt securities. Now, on the balance sheet, the debt securities amount to 322, 421, 102. Where am I getting those values? Just sort of a non-clicker question. Held to maturity, what is the value on the balance sheet? Which one of the numbers up there under the held to maturity columns would be on the balance sheet? Which one? What column would you look at for held to maturity? Amortized cost, and the total amortized cost is going to be here at, sorry, let me make sure I get that straight, at 197. Available for sale, has available for sale carried. Cost or fair value? Fair value, so available for sale will be carried, at 123, or 125 rather. Now, the trouble is you don't get to see, and I guess if you read the rest of the footnote, you'll know what's short-term and what's long-term, but the portfolio, the held to maturity, is at cost 197, 297, 731, and the available for sale in the footnote 125, 123, 371. And that will should come to 322. That's the value, that's how the debt is valued on the balance sheet. Now, in the footnotes, I mean, you'd have to read this through to see what's short-term, what's long-term. And this is what I mean by a mixed attributes model. We're adding fair values to cost. So when you go to the balance sheet, you're actually adding fair values to cost. And although this is going to change, we really should get, I mean, they really want us to have better disclosures, and I'll show you some of those better disclosures in a second. But that right now is what we're looking at. We've got a mixed attributes model where we combine both the historical cost and the fair values. Also in the footnote, they talk about, as I mentioned, talking about the, let me highlight this for you, the equity securities of approximately 3574 is sitting on the balance sheet as well. Okay. So, typical disclosure, there's no trading for this company, as you would expect. Companies that don't have a regular operation or a regular institution within the organization that trade securities, such as the, I guess the treasury function, would not have any trading securities. Okay. All right. Any questions? Any questions? Okay. All right, now, at the end of this module, I'm not going to, again, the clickers, I'm kind of skeptical because we have a mixed crowd here. I don't know if they're going to work, but let's just look at a couple of these. The first question is a definition. So that's not an issue. That is a definition of trading securities. So the first one is true. Second one, unrealized holding gains and losses are recognized in net income. All right, so how would you answer that one? False or true. I mean, it's false if what's the case? If it's available for sale, and would that be enough? Well, as you're writing the essay, say, okay, false. Available for sale securities, where does the unrealized gain and loss get reported? Other comprehensive income. Why? Well, then you have to go through the explanation. Again, it's not part of normal operations. There's a very low probability of short-term cash realization, so there's always a theoretical background. And, of course, you try to avoid volatility in the income statement as well. All right. Number 3. It says a company can classify a debt security as held to maturity if it has a positive intent to hold the security to maturity. Now, again, I wouldn't ask this question because you're missing one word in there. You not only need the intent, but you need the ability. So you'd have to show the accountant the ability, meaning that if based on somebody's analysis of your financial position that requires that you're going to need to sell these quickly to stay liquid, you can't classify them as held to maturity. So if there's any indication that, based on an analytical review of the company, that the securities will have to be sold in the short run before maturity, it cannot be held to maturity. What's that? It does say ability? Oh, I have the wrong, okay. Then it's true. Thank you. Reading off an old version. Okay. All right. So yeah, it is true. Yeah, it's definitely true. It's definitely true. Yeah, it's true. It's got to be both. It's got to be. The explanation is correct, but the answer would be true. It's got to be positive intent and an ability. Yeah, it's up there. Sorry about that. Okay. So you need both. Let me just correct. So yeah, I correct my own typos and don't even know it. All right. Now, of course, number 4 is true. Companies do not report changes in the fair value of available for sale debt securities as income until it's sold, and that, of course, is absolutely true. All right, because again, if it's available for sale, it goes into the other comprehensive income. And 5 is what? Fair value adjustment account is a normal balance of a credit? No. Has no normal balance. As we said, if there's a debit in that account, it would be an adjunct. If it has a credit, it's a contra. There's no normal balance to the fair value adjustment account. No normal balance, because it could be a debit if you're writing the security up. It could be a credit if you are writing the security down. All right. Any other questions before let me minimize this because I'm not going to use this. Okay. All right. Let me, okay. Go to the next. All right, the next module, by the way, I have this model, this fair value model is on Blackboard, and I should have brought some copies with me, but you could hopefully we'll be able to see it on the screen. What I want to do in this module rather, is go over in detail the logic, the theory, and there's no numbers here, so this is going to be up for discussion. Has anyone working in financial services on a internship, did you ever work with the disclosures, level 1, 2, 3? Disclosures, right? Level 1, 2, and 3, that's what we're going to talk about now. These are disclosures that will indicate the reliability of the inputs to the fair value measurement process. So this module is going to help us understand how we measure fair value. We're going to talk about the fair value hierarchy, which is the level 1, 2, and 3. We'll also talk about this fair value option. And again, remember, there's an exposure draft out there that's going to sort of combine all of these standards. It's not going to eliminate a lot of what we do. It's going to change the terminology and not have separate models. It's not going to have a separate fair value option and things like that. All right, so let's take a look at the first. We now have to think about the objectives. There's really no new assets that are going to be measured at fair value under this approach. If you remember from Intermediate 1, we looked at measuring plant and equipment at fair value under IFRS. This is not where we're going here. We're not going to measure any new assets. The idea was to provide a single framework to measure fair value. There's still going to be some differences. So lower of cost or market, the market value used for inventory is not going to be covered here. So you're going to have some exceptions, which we'll show you. But in general, we're trying to come up with a single framework to measure fair value. Before this, it was all over the place, depending on the type of asset. And the disclosures are going to be critical because the disclosures are going to be very important for the user to understand the reliability of the inputs that are used in the fair value measures. Now, in the summary table, which I think you might find interesting, is that when we look at fair value, prior GAAP always looked at fair value as an entry price. How much would you have to pay for the asset to acquire it or to be received if you issued a liability? Now it's completely different. Now there are some exceptions, but we're now using an exit price concept. How much would you receive if you sold the asset, or how much would you have to pay to retire the liability? Now that makes things very different, because if you bought, just think about this for a second, if you bought a fleet of trucks and you put them on your balance sheet, and if we're not measuring them at fair value, but if we were measuring them at fair value under old GAAP, how much would the trucks be worth on a fair value basis? Well, what would I need to pay to replace them? Now we're saying, how much would you get if you sold them? Different number, right? Because the market value would decline as the vehicles become used. The assumptions, we used to use individual entities. Now we're going to look at a broad market-based, and then again, there are exceptions here as well, but a broad market-based measure. We're going to look at what the market would use to value the asset. We're going to measure fair value with a consistent framework, and here is the most important for me, and what I want you to make sure that you don't get confused, because there are inputs into methods to measure fair value, and there are the methods themselves. When you look at the disclosures, the level 1, 2, and 3 hierarchy, which we'll get to in a few minutes, you're looking at the reliability of the inputs, not the reliability of the measurement itself, and not the reliability of the methods. Now, of course, the inputs will drive all of that, but you're looking at the inputs to the measurement process. Now, when we look at fair value, I'm not going to ask you to memorize the definition, but there are some important pieces here. When you look at the definition of fair value, again, we said it's an exit price that could be attained by disposing the asset or paying off a liability. And there's something that's interesting, and I'm just going to tell you what was used in a, I guess, in the recession period, an orderly transaction. Orderly transaction. So a lot of people were saying that they were exempt from this definition because the markets were no longer orderly. You couldn't sell a house in an orderly market, 5 years ago or 6 years ago. You couldn't trade securities in a normal market setting, so I'm not going to use the fair value. So again, these are just some important, I guess, pieces of this definition. So the pieces are, it's got to be an exchange price. You have to measure it or assume an orderly transaction, meaning that you would not assume a bankruptcy or a deep recession or an unusual market. And then we're going to look at a market participant approach in a principal or most advantageous market. When we look at the market participants, they do say, you have to think about a market where the person is independent from the company, you have knowledge, you have the financial ability, and someone is willing to trade. And I'll show you how that works in a second. The steps, and that's what we're going to get into, in measuring the fair value are listed here. Now let me see if I can get this up on the screen for you. Okay, so let me move this over. Hopefully this fits. Okay, here we go. All right, you have this, actually we have this up on Blackboard, and it's not in the notes. I should have emailed this to you, but the steps are listed in the notes. But when you have a chance, you can print this out. There are 6 steps in measuring fair value. The first step is getting the unit of account. Now, the unit of account is generally pretty simple. It could be, if it's a derivative or a financial instrument, it's 1 share of stock. It could be more complicated when you're dealing with goodwill, because don't forget, in a goodwill impairment, you have to measure the fair value of the reporting unit. How do you know where the goodwill resides? That's the question. So if you buy, for example, well, I think I did this with you in Intermediate 1. If not, just picture a company that buys a retail outlet that has 3 stores and a credit division. They're really buying the company for the quality of its credit division. That's where the goodwill is located. So it is located in that unit, and that's where you would use the fair value. That would be the unit that you would measure. Now, for us, I'm going to keep it simple. The first step is, if I'm valuing a share of stock or a derivative, I'm going to take the unit of account as 1 share of stock. And it's going to look, by the way, when I get done with this, it's going to look like really, really obvious, because I'm going to use something that's easy to measure. Life gets very difficult with this model when some of the target items that we're trying to value are not quite so transparent, such as the goodwill. Okay. Now, the second step is we have to try to determine the markets that we're going to use based on what is known as the highest and best use of the asset. The question here is, where does the company maximize its value? Does it maximize its value by using the asset in combination with others, or by selling it? So, for example, if you had computer hardware and computer software, using them together might maximize the value of the computer division or that particular asset. If you're selling real estate, then the highest and best use may be in exchange, so that the best use of the asset could be either in use, and when we say in use, it means in combination with other assets. So the terminology in use means in combination with other assets. Another example would be if you're trying to value a factory, if you're buying a manufacturing facility. Okay. The asset you're buying is really the entire manufacturing facility. So you have to value the assets together in use, not separately. So you're not selling the building, the land, the equipment separately in the inventory, you're valuing the entire package. So in use would be assets in combination, in exchange would be assets being sold separately. So the highest and best use in my first example for a share of stock would be in exchange. And also you have to think about the markets. What about real estate? I mean, if you read the FASB standards, which you may or may not have to at some point, you'll see they use examples like real estate. I have a piece of land. What's my best use of this? What market should I be in? I'm thinking, okay, real estate, obviously a piece of land has to be in exchange. It can't be in combination, right? But the question is, real estate in commercial markets versus, individual or housing markets could be a little bit different. Commercial versus residential real estate could be a little different. So we have to think about the market. So in this case, so far, and I'm just using a very simple example, I have one share of stock and its highest and best use will be in exchange. Then the next question is, once I know how I need to value the asset, for example, if I was going to value the factory in total, I would have to get appraisals from a real estate specialist that would deal with appraising manufacturing facilities. That would be the market I would look at. And the market you would look at would be a market that is either a principal market, and that's where you would go first. So what you're looking for, and when you look at these markets, you would start with a principal market. Sorry about that. You start with a principal market. And basically the principal market is going to be the market with the most volume, active trading, easy access or unlimited access. If there is no principal market, you would move to a most advantageous market, and what that is, and that's a market where you would maximize your proceeds, net proceeds on the sale. So the example I give you on the bottom of page 3 is to say if I took a security in exchange and I'm going to sell it, I can either sell it on a domestic market or an international market. Okay? If I don't have a principal market, I would look at the most advantageous. If I don't have a principal market, the most advantageous market in my example would happen to be the domestic market. That's where I would maximize my cash flows. Okay? And then finally, although this is probably not going to take place, if the asset has no market at all, you could create a hypothetical market, and that's going to be rare. So you could create a hypothetical market. Now, in my case, if you look at step 3, my share of stock is publicly traded, so the New York Stock Exchange would be the principal market where I would trade that security. And that would be, again, thinking about this from a market participant's view, that's the way I would trade and everyone else in the room would trade this security. Okay, so that's the third step. Any questions so far? I mean, this is pretty theoretical, but you have to make sure you go back, especially, in practice and the CPA exam and all of that. These come up quite a bit. So unit of account is one share of stock. Then the highest and best use, we determine how we need, I'm going to give you another example in just a minute, how we need to view the asset. Do we view it in exchange individually, like a piece of land and real estate, or one share of stock? Financial asset, financial instruments would be sold in exchange, or do I look at it in combination with other assets? Do I look at it with a package of other assets? Then once I do that, I know how the asset should be exchanged as an exit, or, in other words, when I go to sell it as an exit price. And then the question is, where is the best market. Do I have a principal market, high volume, active trading? That would be the first place I would go. If that doesn't exist, I would then look for the most advantageous market. And if not, I'd have a hypothetical. Yeah.
So in the stock exchange example, there are multiple exchanges. How do you, so it's because you have multiple principals you then determine?
Yeah, I mean, in that case, if you had multiple principal markets, you would drop to where you would get the highest, where you would maximize the value. Yeah. Transactions cost may be an issue. In fact, in my example, I show you that there is a domestic market and an international market, but because the transactions cost in the international market are so high, the net proceeds are better in the domestic market. Now, if there's one thing I have to say is that if you have, let's say, a selling price or a market value, market value of 100 per share, and if there is a fee of like $5, 95 is what you use to compare. So let's say we have two markets, A and B. And that doesn't make any sense. Let me make this 30, okay? All right, so if you have two markets, A and B, obviously the most advantageous market would be market A. I'm just going to tell you, though, what goes on the balance sheet. 100. So even though the net is used for this test as to what's most advantageous, the 100 is what goes on the balance sheet if you're using fair value. So the fees are used to determine the most advantageous market, but not to be put on the balance sheet. All right, so at this point, we now know what the unit of account is, how you're going to exchange it, either in combination or individually, either in use or in exchange, how you're going to value it. You now know the market, and you now need to think about the market mechanism or the approach. Now, obviously, it's easy for the New York Stock Exchange, but if you take a look at page 4 in the notes, I'm going to list this on the board. The methods that we use. Now, again, not to confuse this with inputs, but the methods that we use. You have a market approach. You have something known as an income approach. And a replacement cost, or it says cost here, but I'll say cost. It's actually replacement cost. Okay, so you have a market, you have an income, and you have a replacement cost approach. Now, it's kind of hard to really separate these from the inputs that you use in lots of ways, but the key for the FASB is that wherever possible, you need to use observable inputs so that the less estimation you use, the better it's going to be. So you want to get the measure, the valuation technique. You want to do that with the most observable inputs. Now, a market approach would probably be a quoted market price. That's something that you would expect. Now, the problem here is it's not always that straightforward. I mean, you may want to use a quoted market price for an identical asset or a comparable asset. The question is whether or not that quoted market price is based off of a market that has a high volume. I mean, there's a lot of issues that go here, but typically the market approach would be a quoted market price. A market transaction either using an identical or a comparable security. An identical or a comparable security. The income approach, this is a discounted cash flow or a model that you might think about using Black-Scholes, for example. So this would be like a discounted cash flow model where you would take a stream of income or a stream of cash flows and discount it back to get the fair value. Black-Scholes is another example of a income approach. So the Black-Scholes model is an example of an income approach. And then finally, the cost or replacement cost approach. This is really an exception. This is really not an exit price. It's how much you would have to pay to replace the asset. Now, you might think that that's easy. It is for assets that are still traded. It's not very easy if the asset is not currently on the market. And replacement cost was once required by the Securities and Exchange Commission. Years ago, the SEC, and I'm talking, maybe, 40 years ago, maybe 1974, 1975, the SEC required replacement cost. How do you get replacement cost? If the market is there and the asset's currently traded, you could find it. What would you do if you have a machine that was built, and I'm going to give you an example. One of my clients was in Jersey City. In fact, it was on Grand Avenue, if you know what that is. It kind of faced right down, the World Trade Center was right down the street. You could actually see it. Go, make a turn, go in there. Roofing factory. They were making tar paper for roofs. The factory was built, I don't know, early 1900s. The gears were made out of wood. And we had to bring in a specialist to tell us what would it cost us not to replace that asset with a new asset. What would it cost to replace that asset? To get someone to build an asset with wooden gears. Now you can see what a waste of money that was, and that's why we no longer use replacement cost. That went away real quick. It was extremely expensive. First of all, I'm spending my time in a factory with a consultant trying to value an asset that is no longer being produced. So that's what you'd be facing here. If the asset is no longer produced, you would have to come up with a similar asset to replace the asset that is there. Now today you'd probably have much more leeway, but you would have to come up with the replacement cost. Now, you can use one or all of these techniques. Let's take the factory, for example. All right. For valuing a factory, you can use all three. The land and the building, you could probably get a quoted market price from a similar building and land that was recently sold, a market comparable on a precedent transaction. So that if a building in the area recently sold, I could get a real estate quote for the building and for the land. For the equipment, I may have to use a discounted cash flow model for some of the equipment, or I can use a replacement cost approach if the assets are not actively traded. So you may wind up with a combination of all of these valuation methods. Now, the bigger problem, of course, is the reliability of the inputs to those measures. And that's what we'll get to next. But before we go on, so let's take my example. One share of stock, second step, what's the highest and best use? I'm going to sell it in exchange. New York Stock Exchange is my principal market, and I get a quoted market price. So I'd use a market approach here. Now, as I said, by using a share of stock, this looks way too easy, but just think about some of the things I'm talking about in practice. It takes a lot of time, a lot of effort, and a lot of estimation in many cases to come up with the fair value. And you have to remember, the purpose of this model is not really designed to measure a share of stock. It was designed to have a consistent measure of all types of exotic assets like derivatives and all kinds of, different types of financial instruments, and on top of that, to measure other types of assets. So all assets will be measured in the same way by using this particular model. Okay. Any questions on the fourth step with these approaches? Okay. All right, let's go to the next one. Well, the fifth step is just applying. Now, in my example, step 5 is really easy. I'm just going to take a quoted market price against the number of shares I'm dealing with, right? It's a quoted market price against the number of shares, but in practice it may be a little bit more difficult. So, for example, if you had, let's take a factory, and you've seen this in Intro to Accounting, I think, where you have an asset, a factory, that's sold for one price, and you have to allocate it. So when an asset is in use, you may have to allocate the price between the two assets, or the fair value between the two assets. In my case, it's just going to be a simple multiplication. So step 5 is really not a big problem unless you're allocating among diverse assets. Finally, in step 6, this is the key. I mean, for me, for financial statement users, for financial analysts, this is the absolute most important piece of this. This is the fair value hierarchy. This is where you would list the level of reliability of the inputs into these models, so that if I had something like a Black-Scholes model, I've got all different levels working through there. The quoted market price for a security, the same security is a level 1. It's the highest. Level 3 is the lowest. Now, in my case, my step 6, it's going to be a level 1. So when you look at this model, again, just it's on Blackboard, you could print this out, but that's the approach that we're using, steps 1 through 6. Now let me get back into this module and show you what these levels look like. I'm not going to, again, you don't have to memorize everything that's in here, but let's look at the levels. In the footnotes to the financial statements, you have to disclose. Let me give you a page, I'm sorry. This is on page 5 of the module, module 2. You have to describe in the footnotes to the financial statements, for every fair value measure that you use on your balance sheet, you have to describe, or at least qualify or classify the level of reliability of the inputs. A level 1 is a quoted market price for an identical asset or liability. Pretty simple. It would be my quoted market price on the New York Stock Exchange. Now, again, you have to read into this more deeply for different types of assets, but when you go to a level 2, this would be something then different than a quoted market price directly for the security itself. This would be, for example, and I give you some illustrations, A, B, and C, it would be a quoted price for a similar or a comparable asset or in an active market. It could be a quoted price for the same asset in markets that are not active if that's all you have. And it could be other inputs based on just derived from other market observed inputs. So for example, if you're looking at real estate in Manhattan or in New Jersey, downtown Jersey City, you may get a price per square foot for the particular building that's observable, and you may want to apply it to a new building that you're putting up. There are other transactions that you might use as a benchmark to value that building. And then, of course, a level 3, these are the unobservable inputs. This is where you have management coming up with estimates with discounted cash flows or a Black-Scholes model. So that the other example we did in Intermediate 1 was an asset retirement obligation, where you have to project the value of that liability, and we're basically using the same model. The same model is being used. We know the unit of account. We're trying to determine the replacement or at least the restoration of the property. We have to think about the projection out for that cost to reclimate the property, and then we use a discounted cash flow. So this, by the way, is an income approach. That's basically an income approach to valuation. Black-Scholes, that's going to fall, where does that fall in, do you think? Yeah, Black-Scholes would be a level 3, I think. Because, well, what do you have in a Black-Scholes model? You've got the estimated volatility, but then again, that could be a market corroborated. So maybe that's kind of like a, it's kind of like a level 2 maybe. You may have, estimated, that could be a level 3. If it's something you can't really observe, the risk-free rate is what? Observed. So that's a level 1. So it's got combinations. So what I'm saying is that you have to value or at least rank, I should say, in the hierarchy based on the lowest level. The lowest level drives the classification. So even though a Black-Scholes model has the risk-free rate, which is observable, it's management's estimate in the volatility, and that might make it a level 3. It's probably a level 3. It could be a level 2, depending on where you get the volatility from, right? Because if the stock is traded, the market, could be market observed volatility of the stock. But again, it's got lots of estimates in there.
So basically, BNB 3 would be rated as the lowest.
Yes.
3 being the lowest.
Yeah.
So Black-Scholes falls on the lowest.
Lowest, yeah. So when you have a given valuation and it falls into different levels, the lowest level drives the entire classification. So if you have levels 1, 2, and 3 in your inputs, it becomes a level 3. If you have levels 1 and 2, it becomes a level 2. So the lowest level of the inputs drives the entire classification. Okay. Now, just to give you an idea of some of the disclosures, if you look at let's go to page 6 as a sample. This came from the FASB as a sample of what we should be reporting on our balance sheet and the footnotes. Essentially, you would have in your fair value measures, you're valuing trading securities at fair value, which we know available for sale at fair value. Derivatives are valued at fair value. And again, you'll pick that up in probably the summer. I don't know if I'll have a chance. I'll try to go back to that if I can. At the end of this module, there's module 4, which we could circle back if we have time. I don't think so, but we might. And then other investments. So if you look at the trading securities, most of those are level 1, but if you go to the balance sheet, you're going to see them at fair value at $138. But in the footnotes to the financial statements, you have to tell the reader how much of this is not based on quoted market prices. What level of risk is embedded in that fair value? When you look at the derivatives, right, so you do have some of them that may be publicly traded, but you do have obviously lots of that value being pushed out into the lower levels. And then other investments, all of that is a level 3. Now, it was my understanding, and I don't know if it's true, if anyone's worked with this, let me know, but it was my understanding that when this standard first came out, nobody used a level 2. So what most accounting firms said is, I'm not going to take any chances. It's either a level 1. If I don't observe it, it's level 3. If I can't observe the input, it's level 3. If it's not a quoted market price, it's a level 3. So almost everyone that I spoke to in practice at the time was handling it that way. That could have been because of the initial issues regarding the uncertainty as to how these disclosures are going to be used. Now, when you have a level 3, if you look at the footnote, and we don't need to go through tons of this detail, but you should understand that you do need to spend a little bit more time on disclosures with a level 3. With a level 3, you'd have to indicate the changes in the level 3 measures, how much of that level 3 fluctuation is impacting earnings. So if you go to page 7 rather, how much of the level 3 is impacting earnings, how much of it is in comprehensive income, and reconciling the beginning and the ending balance. And how much of this how much of these level 3 securities are still being held at the financial reporting date. Okay. All right, and then finally, and by the way, these are for assets that have significant unobservable inputs. These are assets that you report. Obviously, everything in here, let me go back to page 6, everything in here you're reporting on a regular basis. I mean, you measure trading securities available for sale, derivatives on a regular basis at fair value. But if you go to the last part of this illustration, which is on page 8, these are assets that we will only measure at fair value if we write them down. So goodwill, if goodwill is impaired, and these are all losses on impaired assets, which we covered last semester. If you remember, when we were going through, I guess, chapters 12, 13, when we looked at all these impairments, you had goodwill impairment, assets that were impaired that were held for sale, assets that were impaired that were still on your balance sheet. And notice, of course, that you would have really, especially for the goodwill, you're not going to be able to have, there's no market for goodwill. So goodwill would be, totally a level 3, and the write-down of the goodwill was $72 million at that time, or in this example, so that for assets that are not regularly marked to market or measured at fair value, you have to show them in a separate disclosure. All right, so that is the fair value model. So what I would ask you to do is to make sure you look at the steps, understand what's going on in the steps, and in particular, make sure you're clear about what goes into what levels and what the levels are trying to show you. Again, it's the reliability of the input into that process. By the way, goodwill is probably measured, as you know, when we look at goodwill, when we measure the impairment, we actually go through almost a mock acquisition, and we value the unit as if it was going to be sold, or what someone would obviously be willing to pay for it. But the exit price, if you were going to sell that unit, what would its market value be? And then from that we get an implied value of goodwill. And that implied value is the same goodwill that you would get if this was a merger and acquisition taking place today. Okay, last is this last standard, and again, all of this is going to be pulled together at some point if the new exposure draft becomes a standard. And this last piece is ASC 825, and this is the fair value option. The fair value option is pretty interesting because it now tells corporations that they have an option to value a large number of financial assets and liabilities at fair value. When you look at the fair value option, let me just make sure that this is very clear. It's going to be different than, now you've got, and I'm going to use the terminology that we see in the, or at least issued in the exposure draft. So far, what you've looked at with available for sale and trading, you had fair value going into net income, and that was trading. And you're using an allowance account. Available for sale, you had fair value going into other comprehensive income. And that also used an allowance account. Now the standard setters are telling us, well, look, I don't care, and by the way, you could also have held to maturity, and that's at cost. And there are a lot of other assets that I'm going to throw into this pile in a minute, but now they're telling you, well, you know what you can do? If you use the fair value option, all of these can be measured at fair value with the gain and loss, the unrealized gain and loss going into net income. So basically, you're just throwing out held to maturity, you're throwing out available for sale, and you're throwing out trading. If you want to market at your option, you can do so, and then everything goes into net income, but there's no allowance account. At the date of acquisition, right? It's at the date of acquisition or the date of adoption. Date of adopting the standard. So there's no allowance account. And that's because, getting back to, and that's why, when we were going through the discussion about using an allowance or changing the allowance at the end of the year and all that a while back when we were doing the trading, the reason why this is important is because this is done by an instrument basis. So you could acquire a security today, decide to use the fair value option, buy the same security tomorrow, don't use the fair value option. Now, the reason why the fair value option was put into place under U.S. GAAP was to allow companies to offset unfavorable price fluctuations in the market without getting involved with derivatives, without having to hedge. You could actually hedge by using the fair value option, which I'm going to show you in just a second. Okay. All right, so there's no allowance account, and I guess you could use one if you wanted to, but we typically don't. The other important point here is that, that when we, in some cases, when you buy an investment, you sometimes take the transactions cost and add it. So for instance, when you buy, if you were investing in stock and the stock costs you $5 a share plus $1 commission, how much would you put into the account? Some people would put $6. Most people would put $6, right? It costs you $6. Here they're telling you that the transactions cost have to be expensed. So you have to expense all transactions costs. So we're expensing them. We're not going to put them. It's not going to be capitalized as part of the cost of the asset. Okay. Now, one of the big differences with IFRS, in order to use a fair value option under IFRS, you must prove that you're doing it to hedge. So it has to be part of your hedging activities. Under U.S. GAAP, it simply says it could be used to hedge stock price volatility. Now, let me show you what this means. Let me give you an example. So this is on the bottom of page 8, going into page 9. Let me give you this example. This assumes, by the way, someone I know mentioned it has to be at adoption, at the date of purchase, or if you adopt the standard. So if you just adopt the fair value option today, you could obviously for the first time, if it was in the adoption period, you could do so. So let's assume you adopt the fair value option now. Let's take an example. It tells you that a company has $1,000 of outstanding debt on its current balance sheet. It also has debt securities. So let's say it issues debt securities. It doesn't really matter if you're initially adopting it. And market rates have increased. So if market rates go up, the value of the debt investment you're holding is going to go down. To offset the loss, if you elect the fair value option for your debt, if market rates go up, the value of your debt goes down. To buy it back, it's cheaper, so it's a gain. Correct? So if you're holding debt and market rates drop, well, market rates go up rather, and your debt is cheaper to buy back, you've got a gain. So basically what happens in this hedging idea is that if you had the debt securities in the trading portfolio, there's a loss, and the loss goes into income, and I'm just giving you the number 250. So again, interest rates have increased, lowering the value of your investment. So the journal entry that you would make, you would debit the loss in income, credit the valuation allowance, and for the bonds payable, if you mark to market using the fair value option. So if you elected to value these securities, usually when they're issued, by the way, that should be, because don't forget you got debt securities, so this is date of issue or acquisition. This should be date of issue also. So if you elected the fair value option on the date you issue those bonds or on the date you adopted the standard for the first time, that means that if interest rates go up, the value of your debt liability is going to go down, and it's a gain. So you would debit the bonds payable. We typically do not use an allowance account, but sometimes if you do it, it's not the end of the world, but you typically would not here. So I would say, again, most people would not use it. You would debit the bonds directly. You write the bonds down to market, and you credit the gain. So what happens here is you're offsetting, and that's where the hedging is coming in. You're offsetting the loss here, so that's the loss, and you're offsetting that with the gain on the fair value option. So the loss of $250, and that's a perfect hedge, of course, but for purposes of illustration, You completely offset the gain or loss. Now, this is recommended under U.S. GAAP, but it has to be in place to use the fair value option under IFRS. IFRS requires that you're using this option as part of your hedging activities. Okay. All right, now, that's the fair value option. When, or I should say, what securities are eligible? Again, they call it contract by contract, instrument by instrument. I said that already. Let me just point out, I'm not going to ask you to memorize all of these, obviously, but I just wanted you to note that for the most part, any financial asset recognized and any financial liability are eligible. Now, you see it says accounting under the equity method. We're going to get to the equity method probably on Tuesday in more detail. I may say a little bit about it now, but under the equity method, that's really an off-balance sheet, or in a sense, an unconsolidated subsidiary. Remember, Rob, we talked about this a little bit with the equity method, almost like a proportional consolidation. Under the equity method, you have pretty much an unconsolidated sub. Now we're telling you you can get rid of that equity method and use fair value accounting. So fair value accounting is an option that you could use on a security that you would typically hold as a investment in a subsidiary company. But you don't have to consolidate. That's the thing. That's a very big point. You don't have to consolidate an equity investment. We have in our modules, we have Coca-Cola. Coca-Cola has used the equity method for years. What they do is they'll buy up 30, 40%, never get close to 50 of bottling companies. They don't have to consolidate them, but they pretty much control them. And they benefit from their share of the earnings. And we'll get to the equity method. Equity method in Module 3 is one of the more important topics in this chapter because it really helps you a lot with mergers and acquisitions. And by the way, if you don't take advanced accounting, this is pretty much the basis of mergers and acquisitions. Aside from putting things on big Excel spreadsheets, the concepts are the same. All right. On the other side, what is not eligible? This is important. You can't use the fair value option for any investment that you would have to consolidate. So any investment that you would have to consolidate, and you're going to say, oh, wait a minute, that doesn't make any sense. If I'm consolidating, don't I add up all the assets and liabilities together? Yeah, you do, but what if you have to issue separate company statements? Let's say you own 100% of another company. Do you ever issue separate company statements? Company A, Company B. Your Company A, you're 100% of B. Does anyone know if you would ever issue separate company statements? Okay, why? Well, there's always a why. Always a why. You got to explain it to me. I need to know.
Yes.
Okay? All right, okay, that's good. All right. So, right, because if you don't own 100, well, I said 100, but if you don't own 100%, there's a minority interest. So let's say I buy 75% of your company. The other 25% of the shareholders out there still need to see the subsidiary's financials. Okay? The other very, I guess, easy examples are publicly traded debt. If the sub has publicly traded debt, if you have publicly traded debt, what a lot of people don't realize that is if you have two companies, A and B, and B is still a separate legal entity, and there is debt on their books, the assets of Company A legally do not support the debt of Company B. So you've got to show Company B's assets and their debt if you're not legally dissolving the sub. So if there's publicly traded debt, I've got to show you the separate statements of at least Company B. If that's the case, you have to realize that even if you have to consolidate this company, if you have the investment in Company B is on your books separately, you cannot use the fair value option for that company investment because, Company B investment, because you have to consolidate it. So anything has to be consolidated, variable interest entities as well. Yeah. That's separate company statements. Yeah, if if there's a 10% rule, which basically says that if the total assets of B relative to A are less than 10%, or their income is less than 10%, you don't have to show, in a footnote, you don't have to show separate disclosures. But I'm talking about where company B has publicly traded securities. They have to show separate statements. They have to file a separate set of statements. Okay. Now, that's one, where if you have to consolidate, not going to happen. Pension plans. So everything we're going to look at, pension assets and liabilities, that's coming up in some future chapters. Those assets are not subject to the fair value options. One of our favorite topics, leases, right? I don't know. Lease assets and liabilities cannot be valued under the fair value options. I mean, demand deposits of banks, I'm not going to worry about that. In F, we talked about the beneficial conversion option. Okay, so the beneficial conversion feature, which is recorded on a convertible debt, we covered that. That would also be something that you would not be permitted. These are not eligible. All of these are not eligible to the fair value option. Okay, so you cannot use the fair value option for any investment. You have to consolidate any pension assets and liabilities. You cannot use it for lease assets and liabilities, and you cannot use it for demand deposits, as well as a beneficial conversion option that's shown separately in stockholders' equity. Okay. All right. Now, the balance sheet disclosures, they would like you, if you use the fair value option, they would like you to have these as clear as possible. So, for example, if you go to page 11, let's say you have loans and leases receivable. The FASB recommends, they highly or strongly recommend that you will not necessarily just bury this in a footnote. They would want you in some way, shape, or form to indicate that out of the $890 million or $1,000 of loans and lease receivables that you're reporting on the balance sheet, 550 are going to be at fair value. The other 340 are at cost or some other measure. So that you have to let the reader know regarding the line items, how much of those are at fair value and how much of those are at cost. And that's what we mean, again, by a mixed measurement model or a mixed attributes model. You're adding cost to fair value, but somewhere in the financial statements, you have to indicate whether or not the assets are at fair value or cost. Same thing with equity investments and also liabilities. I mean, liabilities, you could have debt at fair value as well. So again, out of the fair value, out of the total liabilities of 1225, 60 million or 60,000 are at fair value, and the balance, the 1165, is at cost, at amortized cost. So the balance sheet disclosures under the fair value option are hopefully a little bit better. You probably could put this in a footnote, but you have to be very clear. Much better, I think, than what we saw in our previous example for the trading available for sale disclosure, or the held to maturity and available for sale disclosure we saw before. All right, just one last thing. The income statement, we know that everything goes into net income. Unrealized gain and loss goes into net income. And the transactions costs will go into net income as well. Transactions costs go into net income as well. Cash flow statement. depending on whether or not this is a financial institution, the cash flows from some of these securities could be operating, investing, or financing. Financing if it's on the debt side. Okay. All right. Any questions on the fair value option? I mean, it's really, I think, pretty simple what you would need to know. Just to recap the takeaways. Again, under the fair value option, you will adopt it on a security by instrument basis. It has to be on the date of issue. Forget about adopting now, because I guess almost everybody who's going to adopt it already did. The date of issue or acquisition of a security, date of issue of debt, date of acquisition of an investment. This is a model that would have fair value into net income. That would mean that all of the unrealized gains and losses hit the income statement. Typically, we do not use an allowance account. And all of your, and by the way, again, it's an instrument by instrument basis. So a security that you elect to measure at fair value, maybe for purposes of hedging, can be done so this year. You buy the same security next year, it may not be at the fair value option. And your expenses or your transactions costs will be expensed immediately. From the disclosure standpoint, the key point is that you must try to, although you're showing everything on a mixed attributes level, you need to be sure that you are, in fact, indicating clearly how much of each line item is at fair value and how much of each line item is at cost. Okay. All right, now, the disclosures there are very similar to the ones we saw before at the level 1, 2, and 3. IFRS we're not going to worry about, except the point that I made that in order to use the fair value option under IFRS, you must have a definite hedging purpose. You cannot use the fair value option unless you prove that it's done for hedging purposes. Under US GAAP, it is simply a suggestion or a recommendation. Okay. All right, now, let me, probably not going to grade these because I don't have any, with the classes being mixed, but let's just go through some of these questions now just to be sure. Again, we're not going to cover all the detail on IFRS. Okay, so let's take the first. And I want to see, we'll discuss these if, all right, so now we're going to go back, and this will help me review. And if there's anything we have to cover again, we will. Well, let's take the first one. Standalone fair value measures can be used if, using the fair value model, the highest and best use of this asset is in exchange. Just want to get everybody's opinion, see where we stand on this. It's a good time to find out if your clickers don't work. All right, let's see what we have. Right. Okay. All right, yeah, it's okay. The good thing is no one answered C or D. I don't know who that is, but you know, if you tell me, I'll give you extra points or something. Because maybe you probably know a lot more than me. All right. The answer is A, by the way, because in exchange, you would look at a standalone value. In combination with other assets, that's in use. It's a different definition. Where we have assets in use, meaning that you'd have a factory with plant assets, with building, with land. Those valuations would not be standalone values. They'd be values in combination. Again, you might have two individual assets that, if separated, would be sold for less than the asset being used together. So if you take a specialized piece of computer equipment with specialized software. If you separate those two assets, they would be sold separately or individually at a lower value. The highest and best use would be in exchange. Okay. All right, now here's one we've already looked at, but let's just want to get a discussion on this one as well. On a Black-Scholes model, how would you classify it in the hierarchy? How would you classify that one in the hierarchy? Now remember, I said for discussion, so we could get a split on this one. Okay. All right, now, it could, I mean, yeah, we probably would wind up with this in a level 3, probably, because, again, you've got okay. Now, on a Black-Scholes model, where does that fall in? So you've got 3 models. You have 3 models to measure. You've got an income, I should say market, income, and replacements. This will be an income model. And then some of the variables, let's look at the variables itself. The expected dividend yield, you also have the risk-free rate, price volatility. So you might have, for example, an expected dividend yield. If the company's been paying the same dividends for the last 30 years, this could actually be a level 1, could be observed. Risk-free rate is observed level 1. Price volatility, well, that's where we've got some problems. If you get this from historical market fluctuations, it could be a level 2. If you're projecting it out, it could be a level 3. So it could be either one. It could be either a level 2 or 3. So I'm saying here, this could be level 1 or 2. This is definitely a level 1, right? Because the expected dividend yield, if the company pays the same dividends historically, it could be a level 1. The risk-free rate, of course, could be observed, or will be observed, and the price volatility, that could be observed as well, but based on projections, it could be market-based, but not necessarily a quoted market price. So again, as an income model, this is and make sure you know the difference, this is the model, and this is the input, and I'd probably say here, level. Probably a 1 or a 3, that's level 1. That's probably a 2 or 3. Depending on what you have or what information you have at the time. So the fact that the level that you report is based on the lowest level, that's going to be a 3 in the classification. Okay, so again, it could be a 2. Again, not grading these, just to be sure to, have a discussion on that. And I thought I'd use this as a way to really show you how the steps are built in coming up with the levels. Okay. Any questions on that? Because again, I think that disclosure is probably one of the key parts of this standard. Okay. The third one, that's true, of course. I'm not going to worry about that. That's just a definition. Leased assets and obligations, can we carry those at fair value? Nope, that's one of the exceptions. And number 5, that is a true because, as we said, U.S. GAAP recommends or would essentially say that you probably would use risk hedging as a potential reason to adopt the fair value option, but you have obviously other reasons why you can use it. Under IFRS, you have to use it in a hedging scenario. Okay. All right, so are there any other questions? I mean, talked a little bit about the equity method, but are there any other questions regarding the fair value model? Again, I would recommend get the, right off the blackboard. I've got that model. I should have mentioned that to you. I'm sorry if I didn't. Questions? Yeah.
For the cash flow statement, using the fair value option, if there was a loss and it was available for sale, would you minus it from net income like you do with depreciation and then put it?
Okay, so all right, but we're doing the fair value option, or
Yeah.
okay.
Fair value option was available for sale.
Okay. Yeah, if you're using the fair value option, then you don't really have to worry about those categories. So they all kind of now become securities that are marked to market. But nonetheless, yeah, if there was a loss on that, or you said a gain, whatever it was, a gain or loss, it would go into net income.
Yeah, but then for the cash flow statement, would you minus it from net income? So
If it's a loss, it's an add back. A gain would be subtracted. Right. Because again, it's a good question about the all of those. This is a good question. All of the let's say it's operating. Okay, so let me just get, this is a good question, and let me just get to and what we're going to do is probably the last class, I'm going to go through the cash flow statement, and I'm going to go through everything we covered this semester and show you how but this is good, I should have brought this up. All right, the question was, if there is an unrealized loss in net income in the statement of cash flows, of course, in here, this can be either trading or result of the fair value option, right? So it's either trading or a result of the fair value option. And then here, you'd add it back like depreciation because it's a non-cash. Right, so there's no cash flow on that. Because all you would have done is debited the loss and credited the security or the valuation allowance. Because the entry, let's just say it's trading, the entry would have been the entry would have been to debit the loss and to credit the valuation allowance. right, so any other questions on these securities? Anything else